Hi everyone, it's Paul Brown here from Wealth21. This short video just covers investing in bonds. It's a bit more a topic of conversation lately with the increases in bond rates that we've seen over the last couple of years. Firstly and importantly, anything in this short video is just general information only. It's not investment advice. If you've got some specific questions about your circumstances, please feel free to give us a call or seek advice from an authorised financial advisor. Firstly, let's just cover the broad asset classes. We have cash, we have fixed interest, bonds, which is what we're going to discuss today. Term deposits also fall into fixed interest. You've got property, listed and unlisted property, real estate, shares, both Australian and overseas, and then you have alternatives like gold or other sorts of investments that don't really fit into the other four buckets. So let's move on to what are bonds. So bonds are effectively loans that investors make to borrowers in the simplest term. So borrowers are typically governments or companies. Okay, so you're lending money to a borrower for a certain period of time, and in return, investors receive interest payments and also a repayment of the principal at maturity. So the return on bonds is typically derived from an interest rate or a coupon. We'll talk about some other terminology in a moment, but the coupon is determined by the borrower's creditworthiness, the term of the loans, and also the prevailing market conditions. So generally, there will be a higher return or a higher coupon if the term is longer and the credit rating of the borrower is lower. We'll talk about risks in a moment. So let's just look at some terminology relating to bonds. So firstly, you've got face value or principal. This is the amount the borrower promises to pay back at maturity. Okay, you've got the coupon, which is the annual interest rate the borrower pays to the bondholder or the investor. You've got maturity, which is the date when the borrower repays the principal. You've got the yield, which is the return for the investor on holding that bond, and it's typically the coupon divided by the current price. Okay, and then the final one there is rating, and that's an assessment of the borrower's ability and willingness to repay the principal. And typically ratings range from AAA, which is the highest rating, to D, okay, which is the lowest rating. Okay, and so let's look at how you determine the price of a bond. So the price of a bond fluctuates inversely with the prevailing interest rates. So when interest rates rise, the price of bonds fall, and conversely, when interest rates decrease, the price of bonds increases. Okay, so the reason for that is when interest rates rise, investors are demanding a higher return for holding bonds because they can get a higher interest rate elsewhere. Let's look at an example. So in this case, it's a fairly straightforward example. So you've got a bond with a face value or principal of $100. The coupon rate is 5%, so that's the return on the $100 each year. Okay, the maturity for 10 years. So if interest rates are 5%, the price of the bond is $100. Okay, but if market interest rates decrease to 4%, there's actually a formula that can calculate the new price of the bond as $108.10 is what the formula would say, because you're still getting 5% on the bond, but interest rates have decreased to 4%, so the bond has become more valuable. Okay. Conversely, if interest rates increase to 6%, the price of the bond actually falls to, in this case on the formula, $92.65. So that's a formula, but there's also market conditions, and the duration to maturity also affects bond prices. Okay, but that's just to try and explain the inverse relationship between interest rates, market interest rates, and bond prices. Okay, so let's look at the type of bonds. You've got government bonds, so they're typically issued by national governments, Australian government bonds we have, and that's to fund spending or debt obligations, and typically government bonds have a low credit risk. Okay. Then you have corporate bonds issued by companies, often to finance operations or expansion. And typically they offer a higher return than government bonds, but also the credit risk is higher. Okay. So then you have, you've also got a category called municipal bonds, which could be state or local government bonds issued to finance public projects, and there's a varying degree of credit risk depending on the issuer. Okay, I just want to briefly look at term deposits versus bonds, because term deposits and bonds are both considered as fixed interest investments, but they're different really. So term deposits are more like high interest savings account that's not liquid. Okay, they're covered by the government guarantee up to $250,000, but the risks of term deposits are inflation risk, meaning they may not keep up with inflation. Opportunity cost, if you're locked into a term deposit, it's illiquid, so you can't get the money quickly to go elsewhere, and there could be penalties to early withdrawal. Okay, so bonds are loans to governments and companies, so they're different to term deposits, and they're not covered under the government guarantee. Okay, so let's look at some of the risks of bond investments. Typically, interest rate risks. So remember, as we saw in that example, bond prices are inversely related to interest rate risk. Okay, credit risk. There could be a risk that the issuer of the bond defaults on their payments. It could be the interest payments or defaulting on actually repaying the capital. Okay, and bonds with lower credit ratings have a higher risk of default. Okay. So, and the third one there is liquidity risk. So some bonds are easy to sell. Some bonds are less liquid though, meaning it could be harder to find a buyer to sell without incurring losses. Okay. So what are the benefits of bonds? Firstly and importantly, diversification. The bond market is a very large market, and there's lots of different types of bonds, global, domestic bonds. So they reduce the overall risk of a portfolio by providing steady income, and they can offset share market fluctuations. Typically, bonds are not highly correlated with share markets. Meaning sometimes when the share market goes down, bond prices or bond market can go up, and vice versa. Sometimes though, the bond market falls and the share market falls at the same time. That kind of happened in 2022, which was unusual. Another benefit of bonds is they provide regular, predictable cash flows. Okay, and also they offer protection of principal from market downturns, especially if you hold a bond to maturity. So that just covers some of the basics of bonds. I mean, typically people understand how shares work. You're buying a share in a company, you get dividends from the profits, but bonds are a little different. So hopefully that helps. If you've got any questions, please feel free to give me a call, and thanks for watching.